Before we enter definitions, pause and think. Why does a bank charge one interest rate to you and another to someone else? Who decides that rate? Is it market driven or policy driven? When did the system change? Where does the Reserve Bank fit in? How does monetary policy actually reach the borrower? These questions matter because interest rate setting is not a technical detail. It shapes credit flow, investment cycles, and economic growth. The core issue is simple. How do banks decide the minimum interest rate below which they cannot lend? The answer has evolved from the base rate system to the marginal cost of funds based lending rate, that is MCLR system. The base rate system was introduced by the RBI in July 2010. It replaced the earlier benchmark prime lending rate regime. The purpose was transparency. Banks were required to lend above a minimum rate. That minimum was the base rate. It was calculated using average cost of funds, negative carry on statutory reserves like CRR and SLR, that is the cash reserve ratio and statutory liquidity ratio, operating expenses, and a profit margin. The flaw was structural. Base rate was linked to average cost of funds. If a bank had older high cost deposits, the average cost remained high. Even when the RBI reduced the repo rate, lending rates did not fall proportionately. Monetary transmission was weak. Policy cuts did not reach borrowers in time. The RBI repeatedly flagged this gap in its monetary policy statements and internal studies. To address this, MCLR was introduced in April 2016. The conceptual shift was critical. MCLR is based on marginal cost of funds, not average cost. Marginal cost means cost of fresh borrowings. It reflects the latest deposit rates and repo rate changes. This makes lending rates more sensitive to policy signals. Under MCLR, banks compute benchmark rates for different tenures like overnight, 1 month, 6 months, 1 year. The formula includes marginal cost of funds, negative carry on CRR, operating costs, and tenor premium. The tenor premium accounts for longer maturity risk. The theoretical objective was faster transmission. Empirical evidence shows partial improvement. RBI data indicates that transmission improved under MCLR compared to base rate. However, rigidity persisted. Many loans were reset annually. Banks were still slow in passing rate cuts fully. Structural issues like high NPAs and capital constraints reduced rate flexibility. In practice, both systems faced a conflict between policy intent and banking realities. Banks price risk, they protect margins. Monetary transmission depends not just on formula design but on liquidity, competition, and balance sheet health. Recognizing continued inefficiencies, the RBI later introduced external benchmark based lending in 2019. Many retail loans are now linked to repo rate directly. The lesson is clear. Rate setting frameworks are tools. Their effectiveness depends on alignment between regulatory design and market incentives. Future reforms must strengthen transparency, competition, and balance sheet discipline. Monetary policy transmission is not mechanical, it is institutional.